Hi, my name is David Cohen, CEO and founder of Techstars, and this is This Week in Techstars. Every week we'll take an inside look at what's going on with Techstars. We'll look at real issues that real companies in the program have. We're really excited to be filming this first episode. I want to give a quick shout out to Michael Sidorzeski, who helped set up the studio. Did an awesome job. We got a nice setup here. We're at a secret underground bunker in Boulder, Colorado, at an undisclosed location. It's our first episode of This Week in Techstars. We're going to talk today about the origins of Techstars. We have some great guests. We have Brad Feld today on the program, as well as Jeff Clavier, both great mentors in the program. We're going to hear from Ari Newman, who was in the first Techstars program back in 2007, talk about a real issue that they faced, and hear from Brad and Jeff about that issue. Also want to give a quick shout out to SendGrid. They're sponsoring the show today. Over 11 billion emails have been sent with SendGrid. Can that be right? That's a huge number. 27,000 customers. They do transactional email delivery as a service. They make sure your email gets delivered. Check it out. It's at sendgrid.com. I have great customers like GetSatisfaction and Foursquare. It's an awesome product. With that, we're going to jump right in to the first guest, who's Brad Feld. Thanks for joining us today, Brad.
Thanks for having me.
Brad, you're one of the co-founders of Techstars, but you spend most of your time with Foundry Group. Can you just set that up and tell us a little bit about what Foundry Group is all about?
Sure. Foundry Group is a venture capital firm. We make early stage software internet investments. I have three partners. The four of us are based in Boulder, Colorado, but we invest all around the U.S. We're investors in SendGrid, so very happy ones at that. We've invested in companies like Zynga and AdMeld are two that have been in the news lately. We're also very, very active in a variety of themes. If you're interested in the kind of stuff that we invest in, if you go to foundrygroup.com/themes, you can read some about the way that we think about investing.
So you should probably talk to SendGrid about these frivolous sponsorships that they keep doing of shows like this.
I'm very delighted with their sponsorship activity.
So I walked into your office, I think it was in 2006. We had never met. Pitched you this idea of Techstars. Set up, how you received it, what you were thinking when I pitched you that first time we met.
Sure. So I do a thing about once a month that I call Random Day. So I'll meet with kind of anybody that wants to meet with me. They're short meetings, 15 minutes usually, and I'll do 10 to 20 meetings over the course of a day until I just get burnt out. And you came on one of those random days. I'd never met you before, and in fact, I didn't know that we had actually invested in a company together, but we had. When you showed up, I had absolutely no idea what to expect. And what I remember is you kind of, came in, introduced yourself, gave me a little background on what you'd done, made the connection of the company we invested in, and then slid a piece of paper across the table to me that looked like you'd printed it, on a color printer at Kinko's or something earlier that day. And on it was a description for what was your vision for Techstars, and you sort of walked me through it and gave me a very quick sense of this idea of essentially you were finding angel investing to be lonely and frustrating. You also didn't feel like there was a lot of connection to the companies, and you could definitely see where you could help the companies a lot more. I don't think you used the word mentor, but as a mentor, but there wasn't really an obvious way to engage. You would also spend some time with local angel groups, and there really wasn't a lot of activity through that. And you had this vision of helping create a bunch of companies through this program, Techstars, that would essentially provide some seed funding to entrepreneurs that want to get their companies up and going. And that would give you a way to be involved in a lot more companies, but also get other people like you that wanted to be involved in these types of investments. That's sort of the genesis of that first meeting that I remember.
Yeah, and it's funny because we were talking about SendGrid a minute ago. I remember the first time I ever heard the SendGrid pitch, and those guys were talking to me about what they were doing. I felt like I understood that it was a big opportunity, and really at first they didn't. And I sort of feel the same way about that first meeting. Like it was something that was interesting to me, but in a way you really had a much bigger vision about it, and I think really helped make that come true. What were the main things that really appealed to you that you felt like at that time Boulder needed?
Well, I'd done about 75 angel investments prior, independent of the venture investing activity that I'd done. And I saw a recurring theme when I was doing angel investing is that there are some entrepreneurs who know extremely well how to take advantage of working with their early investors, but the vast majority of entrepreneurs don't really know how to engage with them. When I looked at Boulder as a community, Boulder's this fascinating place. I've been years, it's small enough where you can really understand what's going on in the ecosystem, but it's big enough to be interesting and relevant. And in the 2006, I've been here for a little bit over a decade, 11 years. I'd seen a lot of entrepreneurs, and I'd been involved in and invested in a lot of different companies. Seen a lot of entrepreneurs create businesses. I'd seen lots of people have success and failure, me included, in those businesses. But there wasn't really a cohesive center to the entrepreneurial community. There wasn't a thing that all the experienced people and the first-time entrepreneurs or new entrepreneurs that wanted to engage could rally around. There are lots of people doing stuff, but it's very diffuse. And that sense of it being diffuse was no different than it was in lots of other places where I'd been and invested, where you kind of know a couple of the named entrepreneurs in the community, but you don't really know where to go and how to engage in something substantive. And you were really describing this idea that was much more than just, hey, let's show up every now and then and talk about doing something, or let's get together and have a party or an event. You're really talking about, let's go create a bunch of companies and let's make sure we're constantly getting new entrepreneurs into the mix. And I saw in that something that felt like it could really be the core and the center. Not the thing that created all the entrepreneurial community, but really created some glue across that whole entrepreneurial ecosystem.
Yeah, I feel like you really understood that issue right away, probably much better than I did, and I've come to appreciate it. Obviously 5-6 years in now, where one of the problems we have is so many people coming out of the woodwork that want to help these companies. So just the way that the mentors have come out of the woodwork to engage and really get involved in the companies has really surprised me. But I suppose that entrepreneurs that have some success and some luck, and obviously investors, they want to help. So if you give them the opportunity to jump in and do it.
Yeah, I've always had a sort of mental model that you should always have an evil plan. Like when you try to do something, you should recognize, okay, what's my, what do I get out of this if it doesn't work? And I think our view when we first were starting about doing Techstars was, okay, it's going to cost some money. We're going to invest in these companies. Let's assume all the companies are worthless.
Yeah.
What do we get out of this? And I think we agreed that it would be fun, interesting. We'd learn a lot. But we also viewed it as a way to get 20, 25 new entrepreneurs into Boulder and get them engaged with the people sort of in and around the entrepreneurial community in Boulder. So we had a very clear sense as to what our downside case was, if things didn't work out.
Yep. So, that first meeting, when we first got together, you took the meeting. It took me a few months to get on your calendar. I've tried to get plenty of meetings with other VCs that would never meet with me, and you seem to be very open to just sitting with anybody, and obviously something really random came out of it. But why do you have that philosophy about being open?
Well, I'd say it comes from two different dimensions in terms of how I think about things. One is, everything I do, I always try to learn something. And so I view things as a positive experience as long as I learn something from the experience. So, these random days, every one of these 15-minute meetings that I have, I try to learn something. And sure, there are some that I don't learn anything and they're not very satisfying, but most of the time I get something out of it. So that's piece one. Piece two is I have a very deeply held belief that the venture capitalist is actually not the generator of entrepreneurial activity. Entrepreneur is. I also believe that the venture capitalist is not the manager or the curator or the gatekeeper of the entrepreneurial community or the leader. The entrepreneurs have to be. And so I'm very attracted to entrepreneurs who want to drive that entrepreneurial community where I can play a supporting role, which is what I think fundamentally the venture capitalist role is. And so whenever I run into somebody that's interested in engaging, the way you learn about people and the way that you learn to interact with people is you do stuff together. And I think even in fact in our conversation, it was a very quick, sort of reaction, hey, let's go for it. But the burden of doing something was on you. And I was there to support you and help you and nurture it and turn it into something, but you had to do it.
I remember very vividly you basically saying, go make some progress, and I'm in as long as you're not a flake.
Yeah.
Right. You just wanted to see some momentum and more than just talk. But
right
away
also,
you got
it also wasn't go away and come back when you have something to show me. It's let's get going.
Right.
And the burden of keeping it going is yours, not mine. But it wasn't, hey, come back when you have something to show me, kind of attitude.
Right.
And I think that that's an important part of everybody in the entrepreneurial dynamic is that people who are playing to make progress and who are actively engaging in new ideas are the ones that are going to drive things forward. And you often see a lot of people, whether they're investors, sometimes they're angel investors or venture investors, a lot of entrepreneurs who kind of wait for something to happen. If you wait for something to happen, nothing's going to happen.
Yep. Well, 5 years later, or maybe almost 6 now since that meeting, we've run a bunch of Techstars programs. I think we're on our 10th one, our 10th cycle. We're in 4 cities. But for Boulder, how is it really different in your mind today from 5 or 6 years ago? How has it had an impact to have created Techstars?
So I think what Techstars did in Boulder was it really catalyzed again this center of the entrepreneurial community. So it wasn't Boulder was, the word I used earlier was diffuse. It was diffuse like so many other places. There were lots of people doing stuff, but there wasn't a thing for them to focus on for a period of time. The brilliance of Techstars in the context of a place like Boulder is it's only 90 days long. If it was 12 months long, if it was year round, you'd burn all the mentors out. And so the idea that you do it for a period of time, and there's a build up to it through the selection process, there's the program, and then there's investor day, demo day, and then there's the financings that happen, it creates a tempo. And I don't know whether that tempo is once a year or twice a year, but it's not continuous. And as a result of that, what you have in Boulder is it's kind of like summer vacation, right? All of the people who are entrepreneurs and involved in the entrepreneurial community and all of the service providers and all the people that are investing in entrepreneurial companies have this thing every year that they look forward to, they get involved in. There's all, this fresh meat, these new people that come in that are ready to go. And it gives you something tangible to do. So, having been to lots of award dinners and having gotten plenty of awards and having gotten a Lifetime Achievement Award, which to me means that I'm going to die soon. And fortunately, I just renamed it a Midlife Achievement Award instead. That dynamic is fine, but it doesn't do anything. Right. And what Techstars really did was it got people to do stuff. There were a lot of interesting second-order effects. So one of the second-order effects was I think there were a lot of people who weren't comfortable making angel investments started making angel investments. And so entrepreneurs started to reinvest in new entrepreneurs. Another is a lot of the mentors that didn't have relationships before with each other, they knew of each other, but they didn't have working relationships, suddenly started working as mentors on a particular company and they became friends. Yeah. And there were even some cases where people sort of were biased against each other. They'd had some bad experience in their past, maybe between their companies, not even between the two people. And they started working together and realized that whatever that was, nobody could remember why it was. And those relationships developed and grew. And then the last is this real sense of spirit that comes around trying to have everybody succeed. So it's not a zero-sum game. It's, one succeeds, one fails. It's a case where you can have sort of a significant increasing amount of success, which builds the value in the community over time. And even in Boulder, with as much entrepreneurial density as we have, we're nowhere near saturated in terms of the amount of entrepreneurial activity, the amount of companies, et cetera, that could be created here. And I think that's true everywhere. So as long as you view it as in a community, you're playing forward with it rather than playing a zero-sum game or I get something and you lose something, it becomes very powerful. And I think Techstars has done that for Boulder.
I agree. I think it's been really powerful. This week in Techstars, Jeff Clavier of Softtech VC joins us on the show. Thanks, Jeff. We were talking with Brad about entrepreneurial communities. I know you're passionate about entrepreneurial communities in general. What does it take to build an entrepreneurial community that's great?
I think there's a handful of very specific things. One is you have to recognize that entrepreneurial communities are driven by the entrepreneurs. So the leaders in the entrepreneurial community have to be entrepreneurs, or more importantly, entrepreneurs have to commit to lead the entrepreneurial community. I think the next thing is you have to have things that continually engage everybody in the entrepreneurial community. We talked about that a bit in terms of the role that Techstars plays in Boulder. In Silicon Valley, for example, you have an incredibly vibrant entrepreneurial community because you have lots of things like that are happening all the time. When you look throughout the country, the entrepreneurial communities that are sustaining themselves and really building on themselves and becoming really interesting are ones that have things that really deeply and meaningfully engage entrepreneurs with each other and with sources of capital. The next is I think you have to have a very long-term view about what you're doing. So, thinking about what's going to happen next month or next year is not particularly interesting in the context of building a sustainable entrepreneurial community. It comes back to thinking about places like Silicon Valley, which have been building for 50 or 60 years. And in Boulder, we're now probably 15, 20 years into an entrepreneurial build with 2 boom and bust cycles, one around the internet bubble, one around the financial crisis. And Boulder, had its down cycle sort of in the post-internet bubble, but sort of just cruised right through the financial crisis from an entrepreneurial perspective because of that vibrancy of the entrepreneurial community. But you have to really be looking forward for a long time.
And I think the lead by example and the fact that first and foremost you try and help entrepreneurs realize their potential is something that I think you guys have done really, really well with Techstars. And under your sort of leadership, we've seen Boulder sort of morph into a place where people actually fly to and spend time with companies because they know there was going to be like interesting opportunities to invest. And for the longest time, the Europeans have been trying to sort of get to that same point. And only over the past 2-3 years have I seen, Seedcamp and a few other sort of projects in Europe that make a difference. Get Europe, I wouldn't say closer to what we do in Silicon Valley. I'm European, but based in Silicon Valley. But at least build a real ecosystem where people are passionate about supporting each other. And this sort of paid forward, where I don't know why I'm going to help you, but I will help you anyway, is something which happens definitely in a few centers, but not everywhere.
I'd add one thing to that I think is very powerful in this notion of pay it forward. And we talked earlier about sort of why do I take these random meetings? The driver of really amazing entrepreneurs is not money. That's a byproduct of what entrepreneurs do. But entrepreneurs are absolutely fascinated by doing something, creating something, building something, learning things. Entrepreneurial community has to be about that. Mm-hmm. And it has to be about engaging with each other, about learning things, doing things, creating new things. And you recognize that you have lots of ups and downs. Lots of things don't work. Lots of things are worthless. Lots of things you invest in lose money. That's just part of the cycle. So you have to believe that what you're doing is fundamentally interesting, compelling, and important. And I think that's what's so incredibly powerful when you're trying to build something over a long period of time.
What really makes these communities sustainable? What can the leaders be thinking about? Because this is really not new. People have been talking about entrepreneurial communities and ecosystems for a long time. What are the real sustainable things that you can do to make it successful?
I mean, I'll give you 3. One is take a 20-year view. So if you're an entrepreneur and you're passionate about your entrepreneurial community in City X, I don't care where City X is in the world, you care about City X, commit to 20 years for City X from today. You're going to live there for 20 years and you're going to be engaged as an entrepreneur and as a leader in City X for 20 years. That's one. Second is recognize that engaging means doing things with other people in the entrepreneurial community, not just building your own company. So if you're a successful entrepreneur, there's periods of time where you're completely consumed and absorbed in your company and it's very hard to lift your head up. But there's lots of times where you're not. And during those periods of time, figuring out how to essentially, going back to this notion that it's not a zero-sum game, move things forward in a meaningful way is really powerful. And then the last is always get new people into that entrepreneurial community. Make it really easy for a kid coming out of school, somebody that moved from another city to your city, somebody that has been working at a big company and wants to be working for a small company or an entrepreneurial company. Make it easy for those people to get involved. Be accessible, be responsive, connect them around the system. When people from out of town, we love it when people from the big city come to Boulder, like Jeff. I mean, everybody, hey, he's here, awesome, let's take care of him, right? That's powerful. Like, make sure that when people come, you infect them with your enthusiasm about what you're doing.
How important is a university? Obviously, in Silicon Valley, university is very central to the ecosystem at Stanford.
Berkeley. Mm-hmm.
How important is that in general for entrepreneurial communities, in your view?
Well, I think it varies a lot. Like the two communities that have been built around universities in the United States that have been incredibly successful are Silicon Valley and Cambridge. Mm-hmm. Those are the two. You look at lots of other sort of tier 1 schools throughout the country, and they are not really the drivers of the growth of the entrepreneurial community in many cases. They are an input. So in Boulder, for example, CU Boulder is a great school, but the computer science department is not particularly entrepreneurial. It doesn't spin off technology companies But every year, there's lots of new kids that go through computer science department, get degrees, learn computer science, and come out and want to engage in entrepreneurship. There's lots of people in other departments that they're part of Boulder, they want to stay in Boulder, and they have a choice. They can go work for a big company or they can work for startups, and they get excited about working for startups. So I think for a place like Boulder, that university is very useful, but is useful as one input. In the same way, frankly, that capital is one input. A lot of people talk about how important it is to have lots of venture capital to be able to sustain an entrepreneurial community. I don't actually think that's true, because capital moves around. And the capital will find great entrepreneurs. And yeah, sure, you need to have a source of capital in that community. But you can build, the more the entrepreneurial community builds, the more it attracts capital. The more it can build, the more it attracts capital. It's a nice positive feedback loop. And I think those are the things that people around the country, as they're thinking about, how do I reignite my entrepreneurial community, instead of saying, well, we don't really have a tier 1 university in our town, that has spinning off lots of companies like Stanford, therefore we can't ever. Well, you're not going to be Silicon Valley.
Ever.
But that shouldn't be the goal, right? You should be something that's great for whatever your city or your community is.
If you look at the one European example which has been working really well, it's Cambridge. The
other Cambridge.
UK, the other Cambridge.
The fake one.
The UK. They were there first.
Oh, okay, that's fair.
And so they've been really good at spinning out a bunch of different sort of types of companies. And even though you couldn't point to the UK as being the most entrepreneurial sort of the cultures, they've done really a good job. Going back to the leadership and someone sort of taking a long-term view, I think it's about someone who really wants to help the community after being successful himself. So I've made money, I want to go back to Ireland, I want to go back to, God forbid, Paris or whatever, and I want to help, fellow entrepreneurs without thinking about my own well-being first, because I'm sort of done there. And if you look at a lot of examples in the Irish community, for example, where very successful guys have made money with European startups, they're moving back and they're trying to really orchestrate the ecosystem, helping a bunch of younger entrepreneurs. And they all have a lot of doubts as to whether it's feasible, because they've read about, or they read about us or whatever, but they don't know what practically it means to actually go to the steps of success. And having those guys helping them along the way is sort of the mentorship and the experience that is required.
I think in some ways also you can create within a city a virtual entrepreneurial university culture. And I don't think it has to be formalized, because a lot of the entrepreneurial activity that happens at a place like MIT or a place like Stanford is informal anyway. Mm-hmm. It's the concentrated collection of people and mentors interacting with each other. And I think you can create that virtually, but you have to, again, be committed to it for a long time. I mean, institutions, succeed because they have a long-term view. And if you want to try to create something like that, having a long-term view is a powerful part.
So I think when you start, you actually have to orchestrate it. I think in our ecosystem, it just happens because the serendipity actually works, because you just put people around the table and then suddenly things happen. If you look at less developed entrepreneurial communities, you actually have to create opportunities for people to meet, or people to sort of open up, pitch sessions, feedback, whatever, where suddenly people feel that, things happen and less orchestration sort of can come later on. Totally. But at the beginning, you have to sort of create the opportunity.
Awesome. I want to switch gears, learn a little bit about you, Jeff, just in general with SoftTech VC. I view you as one of the leaders of the entrepreneurial community in Silicon Valley. I'd like to just have you quickly tell folks about SoftTech VC and your background.
Sure. So SoftTech is a firm which I started 7 years ago. Before that, I was traditional VC, and before that, I did a startup in the financial services market. And really
And before that, you're French.
Yeah, nobody's perfect. And yes, I haven't lost the accent.
No.
So 7 years ago, I saw the opportunity to fund with my own money, a bit like Brad has done forever, entrepreneurs that only needed $500,000 or $250K to get going, as opposed to $5 million back in the late 90s. And I saw that the funding model, the traditional funding model of trying to stuff $5 million in a company, didn't work. So for 3 years, I bootstrapped my own startup, Softtech, by investing in companies, and I was very lucky that a lot of those actually worked. Then I did my Series A. I raised a $15 million fund, and more recently I announced my Series B, which is a larger fund, 35. And the way I think about Softtech is really a startup that funds other startups. And to date, we've done 103 investments, mostly Silicon Valley, 80%, 15% New York, and I'm proud to say that I have 4 in Boulder.
Including SendGrid.
Including
Our sponsor.
SendGrid,
That's right.
our sponsor.
Coincidentally.
Absolutely.
As well as Foodsy, Next Big Sound, and Retail, I believe.
You know them all.
Yes, I'm very up on this.
Yes.
What did you see in those companies?
And you could add Gunip as well, even though they're here, but they started.
Not a Techstars company, but sure.
They're not Techstars, but they're Boulder,
And they're awesome.
and they're awesome.
But what was it about Foodsy, SendGrid, or those other companies that sort of attracted you early on?
It's the usual mix of really smart, interesting, passionate founders, a product which is differentiated, which I think is sort of interesting, has potential. There's not 10 of them on the market, and then playing in a space where, if they execute well, they will build a $50-100 million company that will be uncapped in terms of potential. So they get to 100, but they don't stop.
So there's something about you that I think is different. There are a lot of people coming to Techstars now that are mentors that are from San Francisco, from the Valley, and from all over the country and really the world. You've been coming to Techstars since the first program.
Yep.
And you've been here every single year. You've now come to the New York program as well.
Yes.
You've been an awesome mentor around the program. What was it about Techstars that made you want to jump on a plane and go to Boulder and help out that first year?
Brad made me.
That guy?
Well, the thing is, that's true. Brad made me, in the sense that he basically said, we try to hang out when he comes to the Valley and have nice dinners and everything. And so at one of those dinners, it must have been Indian, he said, hey, we're starting this.
I remember.
Yeah?
I remember.
And he said, hey, we're starting this thing in Boulder. We're trying to sort of help local companies by doing some kind of mini incubator. Would you come and be a mentor? And because I love spending time with entrepreneurs, and I knew that if Brad was involved, that would be sort of interesting, I said yes. And so the first year I said, let's go to Boulder and hang out, with David. And I thought it was actually pretty fascinating to see the types of companies you had, and they were not all sort of perfect and interesting because it was sort of the first batch. But I really enjoyed myself, and I enjoyed being in Boulder and hanging out. And so I sort of committed myself to come once a year to Boulder during the summer, because it's kind of nice, and hang out at Techstars like I just did.
Yep. Well, you've seen it in snapshots. So unlike Brad and I, are obviously very close to it and have seen it throughout. You sort of get the 1 year snapshot view. What in your view has been the evolution, or what have you seen change over time?
I think that you have now a much higher bar. So my sense is that your funnel must be much stronger in terms of the companies who apply to the program, because the companies I see now, a lot of them I think make sense. The question on some of them will be, well, is it sort of big enough? Is it sort of, would I invest based on the product, the team, the vision, the market, and so on and so forth? It's funny that this year a couple of Techstars companies actually compete with some of my companies, which is kind of interesting. So we're trying to, so in that case, what do you guys do? Okay.
It's not
one
on
said,
purpose.
we're going to crush them. I like the cockiness, not too much though. So I think it's the funnel must be better because the companies, I think, are stronger. So I'm not sure whether they will all succeed. They will all build something sort of big, but there's a bunch of interesting business innovation which is happening thanks to this crazy architecture which has been built over the past few years in terms of enablement, in terms of distribution. And the Techstars batch of this year is sort of a good example of a bunch of vertical businesses that will be successful, just not clear as to how big companies they will end up.
Mm-hmm. And of course,
whereas in the past they were like, well, I'm not sure it's going to work at all.
No clue.
Yeah.
Oh, well, that's good to know. There are about 3,000 companies a year trying to get into Techstars now, so certainly.
And by the way, I was impressed by the New York batch, which for first year was actually pretty strong.
Yeah, it was a good group. Of course, there are other programs out there that look like Techstars now. We started the Techstars Network to try to help some of them. but by our last count, there were about 130 globally that were sort of startup accelerators, short-term, small funding, mentorship-driven. In your view as investors, is that a good thing for you or a bad thing for you?
So, anything that supports entrepreneurs and entrepreneurship is a good thing. The thing which I'm concerned about very often is when I look at the mentor community surrounding those companies, and I don't feel that they have had essentially the failures and the experience that makes them sort of good mentors. I'm concerned because if you do one startup and you're lucky and you have a good 3-year run and you have a nice $20 million exit, that's great, but you're not experienced. You've seen one thing. And so sometimes I have a feeling that it's too easy to start an incubator. And so personally, I pay a lot of attention to Techstars, obviously, to Y Combinator, which started it all, and to Seedcamp. And that's it. I'm always open to try and help people, time permitting. So I'm not going to fly around the country to sort of spend time with everyone. But I'm just concerned about the quality of the mentors, and rather see a concentrated force supporting less programs and maybe less entrepreneurs, but with better results than things we try to spread really very broadly, and where the quality is therefore sort of questionable.
So I have a little different point of view, but it's interesting and instructive in terms of how we thought about Techstars as well, because from the very beginning, after the first year that David ran Techstars here in Boulder, he had 30, 40 people from around the country say, hey, can we do a Techstars City X?
Yeah.
And we were very deliberate in year 2. David came and we sat and sort of talked about, okay, what's the plan for the next year?
Mm-hmm.
Should we expand geographically? Should we do another program? And my response was, let's do exactly what we just did again. Like, we did a really good job. Let's make sure we've got it nailed. And year 2 was better than year 1. Year 1 was great. Year 2 was better. There were some things that we learned from year 1 and year 2. And the same thing happened. Tons of inbound. Now it's 50, can we do this? And there were a few that had started to pop up, and the response to those few that had started to pop up whenever they approached us was, we just open sourced our approach. We said, here's our documents, here's how we do it. We spent time with them. I think we were mentors for a handful of them, went and spent time at a few of them to try to help, them understand what we do. And frankly, from our standpoint, also to learn how other people were thinking about it, to make sure we were thinking about it as broadly as possible. When Techstars expanded geographically to Boston, it got pulled to Boston by the Boston community.
Mm-hmm.
Bill Warner, who was a successful entrepreneur, said, this has to be in Boston. When it went to Seattle, same thing. Andy Sack and Greg Gottesman pulled it to Seattle. We want to do this in Seattle. And those were cities that I think the expansion was deliberate from a pull perspective. New York was a little more deliberate. We sort of stepped back and said, where else do we want something like this? And New York was a totally obvious place.
Absolutely.
In that context, I think we've tried really hard to help anybody that wants to start something like this in any city get it up and going, recognizing that we can probably help increase their probability of success through exactly what you just described, right? Guys, here are some things you have to do if you want to do this. You have to have high quality mentors. You have to play a multi-year game. You have to have sort of this notion that the mentor engagement is critical to these entrepreneurs. You have to recognize that a lot of things are not going to work. You have to have a funding model that's sustainable versus a funding model that's a one-year grant from your city, right? A bunch of very specific things. And I think when I look at the evolution of Techstars Network, which is now 25, 30 organizations out of the couple of hundred around the world, even within those 30, there's a spectrum. Some are great, some are okay, some are struggling to figure out what they're doing. And the message I give anybody sort of in the world of trying to create an accelerator, or entrepreneurs who are trying to engage in their own entrepreneurial communities, is to recognize that it is a multi-year, multi-experience, right? Multi-time experience. Like, many of the companies that go through these accelerators are going to fail. And that is just part of the experience of being an entrepreneur. In the same way that of your 103 companies, it'd be great if 103 of them were successful, but that's a nice fantasy. That's not going to happen. Of the companies we invest in, not all of them are successful. The companies that go through Techstars, 70% or so have gotten
financing, 30% or so have sort of gone nowhere. But of the 70% that get financing, not 100% of those will ultimately be successful. And I think that message has to keep getting out, because I think the mistake, when I sort of look back at a time frame where things got out of control in 2000, 2001, there wasn't this sense that anything could fail, or that anything would ever fail. Like anything you do would work. And so what happens is everybody sort of comes in expecting it's going to be easy, it's going to work, it's not going to be a big deal. And this shit is just hard.
Yep.
And as long as sort of the whole chain understands that, it's powerful. So I think we've tried to make sure that people understand that as we talk about it.
I think that there's a set of me which really supports this, but the other is, we've heard some horror stories of entrepreneurs moving to, go to to attend some programs that were not properly funded, and those guys ended up, stuck there. I mean, there has been sort of a few unfortunate examples of excess,
and there will be more,
and there will be more. But which is why I think it's. And you guys sort of can't control that, because the what you want to do, which is through the open sourcing, is to really foster as many programs as possible. You just say, hey, make sure you have a solid base, make sure you have people who are really fully committed.
Yep.
Because you can't drive entrepreneurs to failure because of the program itself.
Right. There are an awful lot who don't have those parameters, those things that you talked about. The 25 or so that are in the network, there's 50 or so that we just didn't feel like they were at that level and they were going to put on a great program. So I think you do have to be careful of that.
The other piece of that, which is true even for established programs, is a sort of expectation mismatch. I think we tried really hard, and part of the ability to do it well within Techstars is that each program only has 10 companies, maybe 11. New York has 12, that go through it. But it's
this year.
Right. It's a bounded number. Right, and so by that number being bounded, you're in a position where you don't end up with a group of people that have a mismatch in terms of what they're going to get out of it, what it's going to look like, et cetera. I think that lots of other geographic programs, that expectation mismatch is blurry because there's not the same level of experience. What am I going to get? The accelerator shouldn't oversell what they're going to be providing until they have a track record of actually providing that. And I think that's a challenge in the mix as well.
Cool. We're gonna take a quick break. I want to come back. We're gonna bring in an entrepreneur, because that's what we want to do on this show. Want to get some real feedback for a real entrepreneur who's been through some stuff. Take a quick break. We'll be right back with Ari Newman of FilterBox. Okay, and we're back. We're joined by Ari Newman, who's the founder of FilterBox, which was a Techstars company from 2007. On This Week in Techstars, we want to talk about real issues that real entrepreneurs have dealt with. Tell us a little bit about FilterBox circa 2007, when you joined the first ever Techstars program.
Well, it was all about trying to solve the information overload problem. I was doing a lot of blogging and was constantly subscribing to more and more feeds, and sort of realized that I had a filter problem, hence the name FilterBox. The options available were like Google Alerts and $50K a month, and there was nothing in between. So it became obvious very quickly that business professionals, people that were socially networked, people that were active in early social media, needed a better way to keep a pulse of the web. And there were a lot of other services that I liked, things like, at the time, 37 Signals from a project management standpoint, where sort of the freemium model of delivering something to the SMB space for productivity to make your life better and make technology work for you made a lot of sense.
So I want to set up an issue to talk about, let you kind of frame it, but I remember during Techstars and for maybe a year or so that followed, a lot of the discussion was about the focus of which customers in the market were we really going after, and what were the pricing issues. So can you just set that up and tell us a little bit about what you were thinking about back then?
Yeah, I mean, the whole thing was an experiment. So the approach we took was, we really wanted to understand where our customers were, and they may have been big companies and little companies, but clearly we wanted to have a business relationship with an individual. So to us, the freemium model made a lot of sense, and we weren't clear as to where the customers were in terms of a vertical or horizontal segment. We just knew that if you're a busy business professional and your options were subscribing to feeds and then clicking, mark as read for 7,000 items a day, you probably were looking for something better, and we wanted to develop a relationship with those people and figure it out from there.
Your pricing, if I remember early on, was very much set up around a single user inside a company or maybe a few users, and really targeted more SMB than enterprise, although you're getting a little bit of demand from both.
Yeah.
You had a lot of competitors in the enterprise level. Was the initial goal to sort of go after the smaller businesses by design?
Yeah, I mean, the whole strategy was to go after the gap in the market, right? If you looked at something like Google Alerts, and then you looked at some of these enterprise like news clipping services, there was nothing in between, and there was a huge a huge opportunity to deliver something of value somewhere in between. There was sort of a continuum of pricing that we didn't fully understand, but the feedback that we got at the low end, hey, how does $20 a month for this awesome service sound? Great, I'll sign up. Right? So that's where we started.
But I'm sure you guys as investors see a lot of companies that start off maybe with a low price product. I've seen several that sort of move up market eventually. How do you think about that dynamic? How do you coach an entrepreneur like Ari to sort of think about that and figure out the right approach?
So I'll take a crack at it first. And I remember a conversation very vividly when I was driving to Keystone and I stopped for gas and we were talking, and you were really struggling with trying to go after a broad swath of users at a low price point, or go at a much higher price point after a much more narrow use case.
Right.
And you had started with this sort of broad swath of users, and you were having a lot of trouble getting to a place where you had enough volume across that broad swath of users.
Yeah.
So I think and that was the discussion we're having, is should you dump that low end user base and focus on a much higher user base? Should you figure out that segmentation better? And one of the challenges is if you don't have a built-in scale dynamic in your pricing model, it's very, very hard to shift people from a low user price to a higher user price. If you have a scale dynamic where you have valuable service across some level that you can get users in at a relatively low price point, and they get fundamental value at that low price point, and it has a very, very wide market adoption. But when they step up the volume meaningfully, there's a much higher price point as they ramp. That's very interesting. And I think you were really struggling with, how do I get to that, that ramp up where the value of the user starts to become meaningful?
Right. Well, so as we're going through this week, we were realizing two really important things. One was at the end of the day, what we needed were consumer web app game dynamics at play in a B2B product in order to get that viral adoption, right? The whole invite your colleagues, refer a friend, share a filter or a monitor with somebody, get more people to sign up, 2 people become 5 people, become an office full of people buying. We were, with limited resources and the accelerated timeline we had, we certainly were not fully investing in that feature set and not doing extensive A and B testing to figure out whether it was value based in terms of more filters for your dollar, or feature based, which was advanced analytics or social collaboration. So we were struggling with all of those things while at the same time going through this process of trying to figure this out as to really where was the customer, right? So I remember one day, like I was riding my bike home from work. It was 10 p.m. right, and I sort of had this moment where I was like, oh bleep, like we either have.
Is it fuck or shit?
Well, probably shit,
Okay.
right? Oh shit.
Hey, there could be people that are offended by that kind of language watching this show.
And so I sort of had this oh shit moment where I was like, I might be going to market as a B2B solution, but I need to start thinking, living and breathing consumer if I'm going to do this. I need to think lowest common denominator. I need to simplify the app. I need to completely change the messaging. And this was the sort of moment where we realized we had to make some pretty hard decisions, because that viral, organic, just sort of happens growth where people just convert at a certain rate and all you have to do is get more people through the front door in order to see the business scale. Like, the platform just wasn't set up for that.
We hear a lot of times, Jeff, maybe you could comment on this. I know you've seen it, this $20 to $100 price point, really tough to live in that range. What kind of companies can do it? What kind of companies shouldn't do it?
Well, it's kind of interesting because typically you will start with an initial set of customers who will pay you something, and they will almost self-select and say, hey, I'll pay up to X, and you will take that. And then you will figure out that you could acquire a bunch of customers at that scale, but it's going to be just impossible to build a big company there. And so you're going to try and segment the product, and sometimes you will actually have to shut the door on your initial customers, the one who paid you the $20 to $100, to get to $2,000 to $10,000.
You reading my board packages?
Yeah. I think I've gotten that email from Filterbox, actually.
And I'm thinking about this company where basically we had a freemium approach, and we literally wiped out the entire free part so that everyone becomes a high value customer. And because it's a high touch product, you can't just do a self-serve. And so sometimes you figure out where to go on the basis of what you learn with the initial sort of island of customers to which you say goodbye to. And that's okay.
I'd add to that I think there's a lot of value early on, and I think you started thinking about this. And I remember a conversation, I think it was at the Techstars reunion in Seattle, when we had that lunch at that sushi place that we went to. Remember that?
Right.
Where the conversation evolved into, there's a lot of value in defining who your customer isn't. And a lot of times in a business, as you're struggling with the segmentation, you start from this frame of reference of how can I capture as many customers as possible.
The answer is no.
You end up sort of thinking about it upside down.
Right.
If you define it as who is not my customer, okay, what's left? Is that interesting? No, that's not interesting. Okay, try again. That's a different process. And you sort of came at it from, let me try to capture as many customers as I can.
Yep.
And then over time started shifting to, well, there's a whole bunch of these customers that are never going to pay for it. They're never going to have a return on investment on those customers. Why should I be spending time on them?
So there's something else. I think at that phase in the evolution too, we maybe made another mistake, which was trying to monetize those customers too early, right?
Yep.
So I could make the argument that we were trying to monetize a customer base we didn't fully understand yet. So we were kind of running a lot of micro experiments, which isn't always bad, but had we maybe waited for more data or really gotten to a point where who the customer was obvious before we fully went after monetization, the hockey stick could have been a lot steeper.
I have a good example for that. Is I'm an investor in a company in Seattle called Big Door that you're an investor in as well. And
Are you allowed to plug your investments on the show?
I'm
It's
gonna.
our show.
It's our
we,
show.
we can do whatever the hell we want.
Just saying.
You gonna shut me down? Good luck, baby. And
How about some SendGrid now? No.
Oh, we did that already.
SendGrid. It's wonderful. But let's get back to Big Door. So Big Door has this compelling vision and has built this infrastructure for gamifying all kinds of different web applications. And it can be as simple as gamifying, a blog, all the way up to sort of very complex sites. Major League Baseball just rolled out a big deployment with them where they actually gamify the experience of participating and watching Major League Baseball games. Pretty cool. A little self-referential, but pretty cool. And they started off with a pricing model that was a usage-based pricing model. And so you got it free up to a certain amount of API calls, and above a certain amount of API calls, you started paying per API call, and there was a curve. And the problem was that it was too complicated to understand the pricing curve for these very early adopter customers. And frankly, it wasn't clear where the value dynamic was. And it was clear that there was value, but it wasn't clear what that value point was. And so we spent a lot of time and said, this is the wrong approach. Let's make the usage of this completely free. Because the actual API infrastructure is a cost structure that we can manage. What we're really trying to get to is a virtual economy around each of these publishers. And if we can successfully create a virtual economy around these publishers, there's plenty of money in the system to be able to figure out where to go from there.
Yeah.
What they've done is they've spent the last, maybe 6-9 months since that decision, building and deploying with a number of high-end, high-value publishers. Very, very deep integrations, and they've learned an enormous amount. They provided a ton of value for those publishers for free, but they've also learned an enormous amount about where the layers of value are, where the real upside is. So it's not always that, there's a lot of pressure to, generate some revenue, let's make some money, let's figure it out. In some cases, it's much better, as you said, to sort of step back and say, let me make sure I understand what value I'm actually providing here.
Wind the clock forward 5 years. What did you guys ultimately do? Obviously, the world's very different today, but
Right. I mean, so Jeff was actually alluding to it, right? So what he described, it was almost verbatim to what we did. So everyone said,
Not knowing, by the way.
right? But I mean, you sort of read the play exactly. So everyone said, the cliche that everyone says is, lowering your prices is easy, raising your prices is hard, and that can be true for a number of reasons. But to fast forward, basically, we learned really quickly, hey, the customer is in a couple of these segments. They were either marketers, they were PR folks working at agencies. Occasionally, they were like sole proprietors or small business executives. A lot of other startups and people generally in tech and marketing and PR that were fed up paying outrageous prices for crappy products. And they found us because we were written up on a blog or social media, or someone recommended us, or so on and so forth. Now, what we learned was, in order to actually close them, we needed to give them a demo so they understood the power of the platform. And once you got on the phone with them, it usually took 1 or 2 additional touches to close the deal. So it was like 6 weeks after we really started looking at that data that we realized this is not a zero-touch, self-convert model, and we can close almost as many deals as we can get our hands on. But the economics obviously don't work at the $10 or $20 a month price point. We also then very quickly started to do some experimentation on the phone when we started quoting people. And this new product that we were rolling out, the G2 product, we just started quoting people at $100 a month instead of $20 a month. And instead of getting a negative reaction, we got even more interest, right? So 6-8 weeks later, we execute the pivot. We basically drop freemium from the website. We start listing at $100 a month starting price point. All inside sales model. We hire 2 more people, and revenue started to take off from there.
Yep. Sort of the paradox that it's not a toy anymore. You have to
Yep,
pay a little
that's
more
right.
for it, and you're maybe paying $10,000 a month, and
Yeah.
you take it more seriously.
Absolutely, and that's the issue of a lot of services where if the price point is sort of isn't high enough, it's not a serious decision, it's too
Right.
easy, and then people don't feel sort of involved in it, and so they will drop out, they will churn, and will be sort of not a good customer for you guys.
Right. Now, one of the key things was that, to the Techstars mantra of doing more faster, we had launched the G2 version of our product right around this time. So we weren't just selling the same old not that you can't get away with that, but we weren't just selling the same old product, at almost at a 10x. We also had the launch of the G2 product as part of the story. So we would show people the old product and show them what people were paying, and then the new one at the new price point. And it was pretty easy value prop.
So from there, things started to work great. Obviously today you're part of Jive. You guys were acquired last year.
That's right.
How's life in the big corporate company?
Well, at 400 people, I guess, compared to my 13-person company, it feels pretty big. But life is good. I mean, Jive's an amazing company, and the Filterbox technology is fully baked into the platform now. In fact, we're just launching Jive 5. Very shortly here, and we built yet another brand new version of this thing, so it's fully embedded and being delivered to the enterprise users. So, ironically, you come full circle, and now the technology that we originally built, that we were selling on a per user basis, is now getting sold, organization wide to large companies, so they can take advantage of the social web. So it's been good to see it come around completely.
Yeah, I think we talk a lot about second order effects with Techstars, and you're now a very active mentor in the program. Jive is here in town. Some really amazing things have come out of this, and so I just want to thank you guys all. You've been here from the beginning. You were in the first program. You guys have been mentors since day one and very involved. So thanks for joining us today on This Week in Techstars.
On the very first one.
That's right, the premiere. Hope everybody enjoyed it. Want to give another shout out to SendGrid for sponsoring the show. And thanks again to Michael Sidorzeski of Callisto FM. You should check out his startup, very awesome. He set up the studio, makes all this magic work. We'll see you next week on This Week in Techstars.